Welcome to vTalkInsight, Risk Sentiment Daily for January 1st, 2026. We are coming off one of the strongest years for global risk assets in over half a decade, yet markets are closing the year with a noticeably more cautious tone. Let us unpack how that late-cycle mix of powerful AI-led growth, stretched valuations, and rising macro risks is shaping today's overall risk sentiment. Risk sentiment right now is best described as late cycle and two-way. On one hand, the backdrop still reflects a very strong year for risk assets. The MSCI World has delivered its best annual gain in roughly 6 years. The S&P 500 is up about 17% with more than 50 record closes, and international markets, particularly parts of Europe, have finally started to outpace the United States. At the same time, the final stretch of the year has felt more tentative. The S&P 500 has slipped in recent sessions, including a drop of roughly 0.75% on the last trading day, and commentary points to low conviction and thinner liquidity rather than a clear risk capitulation. Across portfolios, that shows up as a gradual pivot from simple beta toward more selective and defensive positioning. After double-digit equity gains and strong performance from both stocks and bonds, many allocators are talking about rebalancing, trimming cyclicality at the margin, and increasing exposure to defensive sectors ahead of a midterm election year that historically comes with larger peak-to-trough drawdowns. There is also growing recognition that 2026 return expectations look more subdued. Consensus points to S&P 500 gains below long-term averages, even as earnings forecasts remain ambitious and valuations, particularly in AI-exposed assets and some commodity plays, have moved to the upper end of historical ranges. Putting this together, markets are negotiating a balance between still powerful structural growth forces and an expanding list of macro and valuation headwinds. AI and data center investment, solid consumer and labor aggregates, and resilient banks are clear supports. On the other side sit sticky inflation risks, uncertain central bank timing on rate cuts, elevated public debt and political tension, and evidence of froth in pockets of AI and precious metals. The result is not an outright risk-off stance, but a late-cycle, two-way environment where investors are more focused on dispersion, downside scenarios, and volatility management than they were earlier in the year. One of the dominant bearish themes is elevated valuations and AI concentration risk. The AI ecosystem has driven outsized equity gains in 2025, from mega-cap chipmakers and hyperscalers to data center landlords, power equipment suppliers, and even select industrials tied to grid upgrades. Yet many of these names are now priced for near-flawless execution. Some infrastructure-related stocks connected to the AI build-out are reportedly trading at valuations approaching 90 times forward earnings, while free cash flow yields for leading tech platforms have fallen to record lows, leaving little room for disappointment. The concern is not only absolute valuation, but also the concentration of capital and risk. Heavy and increasingly clustered investment in data centers and high-end chips means a growing share of index-level performance depends on continued AI enthusiasm and robust returns on that capex. Several voices flag the risk that if these enormous spending plans fail to translate into broad-based productivity gains, markets could see multiple compression in the AI complex and, by extension, the wider indices. That risk extends beyond equities into credit, where AI-related issuance has risen to roughly 14% of investment-grade supply this year, further concentrating exposure. Valuation anxiety is not confined to AI equities. Precious metals such as silver and gold have delivered their strongest annual performance since the late 1970s, with silver at one point posting a near 33% monthly gain. Exchanges have responded by raising margin requirements multiple times, and some funds have limited new inflows, signaling that speculative behavior is building in parts of the complex. While many investors still argue that AI leaders are underpinned by real earnings power and that today's setup differs from the late 1990s bubble, the combination of high multiples, concentrated positioning, and clear pockets of froth leaves markets more vulnerable to negative surprises. A second key risk driver is policy. inflation, and rate path uncertainty. Recent Federal Reserve minutes highlight meaningful internal disagreement around the pace and timing of rate cuts, with some officials comfortable talking about easing ahead while others favor keeping policy restrictive for an extended period. Markets are currently pricing around 75 basis points of cuts in 2026, yet futures also imply a relatively steady policy rate near 3% out toward 2027, suggesting investors expect only modest easing and a long plateau rather than a sharp cutting cycle. Inflation dynamics complicate that picture. Headline inflation has been trending lower but remains above target, with forward-looking commentary warning that supply chain frictions, tariff pressures, and persistent service sector costs, especially in healthcare, could keep price growth elevated into early next year. At the same time, several yield curves have steepened in ways that are uncomfortable for asset allocators. Two-year Treasury yields have fallen sharply at times while longer maturities stay high, and global aggregate bond indices have seen their sharpest curve steepening since 2016, raising the possibility that long-dated bonds may not provide the same safe haven characteristics in the next risk-off episode. Overlaying this is a subtle but important shift in the growth narrative. Multiple comments describe a potential stagflation-light environment with sub-2% real growth and inflation that proves sticky rather than collapsing, shaped by tight labor markets, firm wage pressures, and structural forces such as lower immigration and accelerating retirements. Looking into 2026, that macro mix coincides with a midterm election cycle where history points to average equity drawdowns on the order of the high teens. Combined with unresolved debates over fiscal deficits, expiring healthcare subsidies, and political limits to further borrowing, this leaves markets more sensitive to data surprises and policy missteps than they were earlier in the expansion. The third major headwind is a broad buildup of geopolitical, cyber, and systemic risks. Conflict in Eastern Europe continues to disrupt trade routes and commodity flows, with repeated attacks on Black Sea infrastructure complicating the supply of key agricultural products and energy. In the Middle East, persistent protests and uncertainty around leadership succession in Iran introduce another potential shock point for regional stability and oil markets, while global supply is also shaped by shifting OPEC decisions and record output from non-OPEC producers. U.S.-China tensions remain a structural concern. Export controls on advanced chips, reports of smuggling networks around high-performance GPUs, and political commentary suggesting conditional allowances for sales into China all reinforce the sense that technology and trade are now central battlegrounds. These frictions are contributing to a slow rewiring of capital flows, with some countries reportedly reconsidering large-scale purchases of U.S. government bonds out of concern for payment security, feeding a longer-term de-dollarization narrative and adding another layer of uncertainty to sovereign funding dynamics. Caught up in this is an escalation in cyber and digital asset risk. State-linked actors have been responsible for a significant share of the roughly $2.7 billion in crypto hacks this year, and AI-driven scams are growing rapidly, increasing the perceived fragility of parts of the digital asset complex. Investors have responded with greater interest in traditional safe havens. Gold and silver have seen their best annual gains since the late 1970s, even as volatility in those markets has forced exchanges to hike margins and some participants to reduce leverage. Together with unsustainably high global debt levels and rising political polarization, this complex risk backdrop argues for a higher probability of episodic volatility spikes and makes the macro regime more difficult to map. Balancing those headwinds, AI-led investment and earnings growth remains a powerful bullish driver. Over 2025, artificial intelligence has contributed to stronger than expected economic growth, not only through direct capital spending on chips and data centers, but also via wealth effects as AI-exposed equities have appreciated and supported consumer spending. This is evolving into a multi-year capex cycle. Demand for advanced chips has surged, with large Chinese technology firms alone reportedly placing orders for millions of next-generation processors, while global foundries and handset chipmakers are guiding to robust double-digit growth in cash flow, revenue, and operating income. the AI trade is also broadening across sectors and capital structures. Investor enthusiasm is rotating from a narrow group of core chip makers to a wider ecosystem that includes data center landlords, power and grid equipment suppliers, storage providers, and diversified industrial names tied to infrastructure build-out. Companies such as major data center real estate platforms are seen as potential catalysts if they can convert AI demand into higher bookings and earnings growth, while energy players and natural gas producers are positioning around the power needs of hyperscale computing, often with substantial free cash flow and exposure that is increasingly decoupled from traditional oil price dynamics. Importantly, many investors argue that today's AI valuations are underpinned by stronger fundamentals than in past tech booms. Large hyperscalers are funding much of their AI build-out from operating cash flows rather than speculative financing, and sector-wide earnings growth for the S&P 500 is projected in the low to mid-teens, with contributions expected to broaden from mega-cap tech into financials and industrials as productivity gains filter through. There are still clear risks if capex overshoots or if AI monetization disappoints, but as of now the growth impulse from AI and its spillover into energy, industrials, and even parts of credit and crypto remains a central pillar supporting risk appetite. A second key support is broad global equity and economic strength. 2025 has delivered one of the strongest worldwide equity rallies in years, with developed and emerging markets both participating and international indices finally beginning to outperform U.S. benchmarks after a long period of lag. European markets such as Germany and Spain have broken through long-term resistance levels, and international valuations are generally seen as less stretched than those in the United States, leading some investors to describe non-U.S. equities as offering meaningful upside into 2026. Macro data have broadly reinforced that constructive equity picture. Robust gross domestic product growth and healthy aggregate labor indicators underpin optimism for continued earnings expansion, while strong consumer spending, fueled by wealth gains since 2019 and steady employment, continues to support top-line growth across many sectors. In housing, falling mortgage rates, improving inventory, and wage growth that is now outpacing home prices are setting the stage for a more meaningful recovery in home sales, even if activity remains well below pre-pandemic levels and builders are still working through elevated inventories. Sector leadership has also broadened relative to earlier in the cycle. Technology remains a key outperformer, particularly areas tied to AI and the power grid, but industrials leveraged to reshoring and infrastructure and aerospace and defense are also expected to stay in the leadership group. At the same time, international banks and select U.S. financials, as well as energy and certain commodities like silver and copper, have broken out technically and are increasingly seen as part of a diversified opportunity set for 2026. This wider base of contributors helps mitigate some of the concentration concerns at the index level, even if it does not eliminate them. The third bullish driver is supportive credit markets and bank resilience. Credit spreads in both investment grade and high yield have tightened to multi-year lows, with high yield spreads sitting under 3 percentage points above benchmarks, reflecting confidence in corporate balance sheets and low near-term default expectations. A large share of recent issuance has gone toward refinancing existing obligations rather than funding aggressive acquisitions or outsized shareholder payouts, which strengthens credit quality and reduces the risk of a classic late-cycle leverage blow-up. Large banks have, so far, navigated this environment well. Despite isolated credit events, major institutions have absorbed losses with limited impact thanks to diversified revenue streams and robust capital positions, reinforcing investor confidence in the sector's ability to withstand shocks. Deregulatory trends and a shift of some lending activity back from private credit to bank balance sheets are seen as potential tailwinds, and there is a view that, after a year of outsized gains in brokers and investment banks, more traditional, scale-driven franchises may reclaim relative leadership. That said, the very tightness of spreads and heavy issuance linked to AI and long-duration tech mean credit is not without risk. If volatility spikes or growth expectations are revised down, spreads could widen sharply from compressed levels, and commentary explicitly warns that in such a scenario, recent outperformance of banks and tech-linked borrowers could reverse quickly. For now, though, supportive credit conditions, disciplined use of proceeds, and the demonstrated ability of large financial institutions to absorb shocks provide an important anchor for overall risk sentiment. They help explain why, even as investors worry about valuations, policy, and geopolitics, the base case for many remains one of continued, if more modest, gains rather than an imminent turn to deep risk aversion. Stepping back, markets are closing 2025 in a distinctly late cycle posture, with powerful AI-led growth, broad global equity strength, and resilient credit and banking systems offset by stretched valuations, policy and inflation uncertainty, and a widening set of geopolitical and cyber risks. How these forces resolve will shape the path of returns and volatility into the 2026 midterm election year, so it will be crucial to track earnings delivery from AI leaders, the evolution of inflation and central bank guidance, and any escalation in geopolitical or systemic stress that could challenge today's cautiously constructive base case. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.